Hello traders, this is Frank Paul from Forex Mentor speaking with you on Saturday, December 7th, although we're referring to a news event, specifically non-farm payrolls in relation to the Euro-US pair in this presentation, which came out on December 6th. And the purpose of this presentation today is just to briefly allude to some important principles that are reflected in our foundation course called Forex News Breakout Trading: How to Profit from Fundamental Volatility, and the related membership service that's available as well. Mostly just focusing on the methodology, and I'm not going to dig too deeply into the mechanics here, but again, more focusing on the principles. And what we're getting at with this methodology is a rational, price-driven, i.e. naked chart method for trading one of two types of technical pattern setups that often occur heading into certain market-moving news items. Now, I really have to add a strong caveat here to manage expectations, quite honestly. You're only going to find a technical setup which aligns with news about 30% of the time. I just want to make that painfully clear that even if you get a dozen or so potentially market moving news items during the week, you will not have any reason to expect that you're going to look for a trade on all of them or even most of them. In fact, you might find a setup on none of them. We're shooting for about one or two market moving tradable news events per week. And that's just the reality. Believe me, I've sliced and diced this thing a billion different ways. I've looked at low-level continuation setups on a 1-minute chart. I've looked at range breakouts. I've looked at any manner of indicator combinations you care to mention, and all of them fail at some point or another. Okay, it's just too hard to get in on a news reaction after the fact, because by then the market is moving so fast. You're trying to grab a ride on a rocket ship that's already left the pad. It's too late by that point. You're too easily thrashed out of the trade. Indicators often lag, particularly when the news reaction comes at the tail end of some kind of long-winded corrective process. The only method that I think makes any sense, hence the word rational we're using in the description here, is one which focuses purely on market flow, support, resistance, and continuation patterns. We document all of that in our comprehensive online video course, which is also available in DVD format, 12 modules spanning over 6 hours. Now, I have to tell you again, in the spirit of complete candor and transparencies here, I have had one person, I have to say just one, but one person who's nonetheless come forward and said he thinks that the course is absolute overkill. It's way too comprehensive. It's way too this. It's way too that. Long and short of it, too long. So if you don't want something that's very fundamental, that covers all the bases from start to finish, you might find it too much. Again, I don't want to oversell or missell or misrepresent what we're trying to do here, but I could throw together a slapdash 15-minute video if that's what people wanted. But I don't think that it's better to provide too little rather than too much. So if anything, we're erring on the side of too much, but we don't want to leave any questions unanswered. So we do have a very comprehensive online video course, and I truly believe that's what's required. If you're a trader with advanced level expertise in topics like support, resistance, market flow, etc., then you can just simply look through our detailed table of contents listing that we have in the members area and choose to simply bypass those modules that are sort of old hat for you. But what we're doing here is clearly identifying two types of technical setups which we've identified as being of most use in any kind of tradable news reaction. We also provide a members-only online area which is updated with fresh content every week, serving to highlight and document the trading methodology in action. That includes a weekly trade recap video, weekly trade of the week chart extract, a blog feature which reflects usually a couple of different news events during the week, talking about the response, how it did or did not relate to a technical setup, the follow-through, etc. So the members area is really designed to amplify and reinforce the learnings in the course content. Just before we take a quick look at today's chart extract, I thought I would mention that if you have any interest in finding out more in terms of what this is all about, please do check out the URL shown here, www.forexmentor.com/FX News Breakout/index.php, or you can simply go to the Forex Mentor public homepage and find us in the course listings. We also have a Twitter feed with the handle shown here at FX News Breakout, although admittedly the content there mostly focuses on announcements to members in terms of when we have new additions to the members area. Okay, so I think that's it in terms of a quick introduction. Now, I mentioned at the outset, I'd like to reflect an important principle here. This is a 1-hour chart for the Euro-US pair heading into Friday's December 6th, potentially market-moving non-farm payrolls. And interestingly, it was a real volatile thrashing about for a lot of pairs other than Euro-US. And the reason why I say that's interesting is because we suggest that you take the view that any U.S. market-moving news, you should attempt to trade on the Euro-US pair. That's the benchmark pair. Now, you might find that there is no setup on this pair, in which case you can look for an appropriate substitute. But the Euro-US is the most liquid Forex pair, and greater liquidity tends to translate into cleaner and clearer technicals. And that was certainly true here. There was volatility into news. It was a little bit scary, in fact, but volatility that ended up being tradable, not just merely price thrashing about within a range and just basically triggering any and all stops, as was the case with some other cross pairs today. But in any event, on the hourly chart here, the setup was as follows. We had, interestingly, another sharp rejection wick low right here for 1 p.m. GMT December 5th, which in turn referenced support in the background. So today's non-farm payrolls was really almost a duplication of this prior trade here, where we had a swing point low for 2 p.m. on the 4th, a nice little 5-wave impulse up to the swing point high for 6 a.m. on the 5th. Now, granted, it was almost a 100% retracement and a very scary, sharp drive lower, which reversed and headed back up again. But the point here is that we had a 60-minute chart uptrend continuation setup. A, at 1 p.m. GMT December 5th, price of 135.43. B, swing point high 7 p.m. December 5th at 136.77. Lots of little spinny tops and dojis, essentially range bound from the round number handle of 136.50 up to this B level. It was really easy to call this corrective action in the uptrend, particularly relating this latest bullish impulse to market flow considerations on the 4-hour and daily charts. So our methodology, first of all, calls for price to spike into support, a clear confluence of support, to be precise, into an expected continuation move upwards if the scenario is bullish, which it is here. Now, there was a lesser confluence comprised of this wee little swing point low here, a channel bottom, overlapping nicely this round number handle of 136.50. So there is a chance some may have looked at this and said, okay, I'm going to put a buy stop expecting a short-lived little pullback to 136.50. But the reason why I don't like this is because this is such a shallow retracement. It's less than the 23.6 Fibonacci retracement. And I always like to see retracements go a little deeper. Now, the unfortunate thing is sometimes the retracement is very shallow. I've been kept out of long trades on very shallow retracements many, many times personally. But I would rather make the mistake of sitting out a trade rather than trying to get in too aggressively and getting stopped out in the event that it is a deeper retracement, which was the case here. So we look at the 38% Fibonacci, which is kind of obscured here. I don't know if you see it, but my charting package is kind of identifying it here. The 38.2% Fibonacci retracement level of 136.26 against the A to B move here, lining up beautifully with the last high right here. So this was the high to beat, and I'm not looking at the wicks, but rather the parallel candle body highs right here for 6 a.m. and 7 a.m. GMT December 5th. And the reason why I'm looking at that is because, again, that overlaps so beautifully with the 38% Fibonacci. So what we do is we don't try to enter at market. It's just way too difficult, particularly after news when the thing is taking off like a rocket. We set a limit entry in roughly the 15-minute interval prior to news coming out, if we can see a clear and compelling confluence. Now, it's a bit of a crapshoot to expect price is going to come all the way from 36.62 to 36.26. It's almost 40 pips that it has to cover before it finds a corrective bottom and heads up again. So this is a little bit unusual that way. I would prefer to see sort of a 15-minute setup where price only has to travel maybe 10 or 20 pips to hit the level in question. But what is not in question is the fact that this is an impulse wave up, corrective action. We should see that correction bottom out on support at some point heading into news or in the aftermath. And there it is. Price just immediately swoons. So if you're looking at this, you're thinking, oh my God, is this thing just going to blast right through? And that's just sometimes one of the things you have to deal with. But setting the limit entry buy here at 136.26, price exceeded it by 6 pips. A little bit of a drawdown, but just enough to ensure a fill. And from there, what we're looking for is price to come up to a logical resistance target. We didn't have anything else to deal with other than this B level, and because that lined up so beautifully with what we call our generic limit exit of 50 pips, the exit that we employ if we can't find a more compelling target, there's a bit of a confluence of resistance. Price came up within 2 hours, and in fact, after hitting that target, it exceeded it pretty substantially. But we're not going to sort of cry over spilt milk, if you will, the pips that got away, because this is not necessarily, I mean, you could have guessed about this outcome, but it wasn't necessarily predictable. Resistance is resistance until price breaks it, and this was good enough for a 50 pip limit exit. The other thing I want to just briefly mention here is how our philosophy reflects market flow considerations in technical setups, not what you might call simple logic. Simple logic would have you believe that if the news is strongly U.S. favorable, that should translate into strength in the greenback, the U.S. dollar, which in relation to this pair ought to have implied a substantial down move, right? U.S. dollar strength at the expense of the euro ought to translate into a short. But there was nothing about this that was bearish as a setup. It was bullish. It was a bullish or uptrend continuation setup. And this reflects the fact that over and over and over again, I can't tell you how many times I've seen this, simple logic would have put you on the wrong side of the trade. If you're looking at strong U.S. jobs numbers and thinking U.S. dollar strength, you would have been sorely disappointed. And we saw a similar situation with market moving GDP news out of Australia earlier this week. Simple logic would have put you on the wrong side of the trade. What put you on the right side was a strong, clear, and compelling technical setup reflecting support resistance and market flow. And that's as briefly and succinctly as I can summarize this. I hope this analysis is helpful to you. And again, if you have any questions or comments, please do check us out at forexmentor.com, fxnewsbreakout/index.php, or you can just simply send me an email via frank@forexmentor.com. Would love to hear from you. Thanks for joining us today. Enjoy the rest of your weekend, and I hope we get the chance to speak to you again real soon. Bye for now.